Welcome to the Portland Property Channel. Today we're going to be discussing Delaware Statutory Trusts, or DSTs. And remember to like and subscribe if you want to learn how to continue to build wealth through real estate. Hi, it's Harlan Mayer, owner and principal broker, and you are on Creative 1031 Exchange today, where we explore all the creative ways to do 1031 exchanges so you can swap till you drop. And today we are meeting with Stephen E. Erickson, who is a wealth strategist. How are you doing today, Stephen?
Good, Harlan. Thanks for the introduction.
Okay, great. Yeah, it's good to have you. You're a wealth strategist, but really, I think we're wealth and lifestyle strategists because lifestyle is what determines, how much money we can invest, and it determines, how much we need to save when we're older. I always ask people, how do you want to spend your 1,300-week vacation? So
Yep.
we want to learn creative strategies, and that's why you're here, because today we are going to talk about what is a DST, the Delaware Statutory Trust.
Yeah. So we're going to talk about DSTs and how you can use them in 1031 exchanges with like-kind properties, and we'll cover different facets of it. But to start with, a DST is actually fractional ownership for investors to kind of pool funds and buy, either a single property or portfolio of properties. And these are quality, institutional quality properties that you can get access to with pretty low entrance fees, typically around, 100,000 minimum.
But just to be clear, these are securitized investments.
Yep.
So this actually requires people to be accredited investors.
That's correct. So an accreditation means that you have at least $1 million in investable assets, or as an individual have over $200,000 a year in income, or as a married filing jointly client that you have over $300,000 a year in income.
Right. And then some financial professionals also qualify as accredited investors. Yeah, guys, this is the type of information that we can get to you through our DST programs that we have, just to help educate you, because we're just trying to educate. There's a lot of different ways to do DSTs, a lot of different ways to do 1031s in general, and that's what we're here for. But again, this is for educational purposes only. We are not giving you investment advice. We are educating you on investment strategies, correct?
That's correct.
Okay.
Yeah, we really like to educate people first and foremost, and do a lot of education before we, make sure that it's the right fit for them. Some people go through the coursework and they're like, this isn't for me. Others, go through the coursework once they're familiar with all the ins and outs of them and the pros and the cons. Then if they're ready, they'll move forward.
Absolutely. So getting into this, so let's start going into what is a DST. So go ahead, Stephen.
Yeah, so the DSTs are, again, fractional ownership, where multiple investors can actually share in the ownership of a single property, or sometimes these DSTs will be structured where there's 2 or 3 or maybe 20 in one DST. And so this allows investors that are doing a 1031 exchange to get into a diversified pool of properties and things that institutional quality stuff that they might not normally be able to access.
If we're going to look at partial ownership structure of choice, what does that mean?
Yeah, so it's really the structure of choice. There's also, kind of historically out there, you have TICs, or tenants in common. And those have been kind of cumbersome because, you'd have a pool of maybe, 30 to 50 investors. They'd get in, they all had a partial ownership, and then one guy wanted to get out, and then they started having, differences of how they wanted the pool of real estate assets to be managed, and it was like herding cats. So a more efficient structure was created, which is called the Delaware Statutory Trust, to help alleviate some of the issues in the TICs.
Right. And so we're going to be looking at key benefits of the 1031 exchange.
So, I love the picture here because it's an example of an offering that was a DST in the past here. Beautiful apartment complex. This is grade A apartment complex. And, most people can't get into one of these for $100,000 minimum. So that's partially why this is the, kind of DST, the partial ownership structure of choice. But, here's like 9 things that, why these are so valuable. First of all, you have no management responsibilities. You don't have to go find a manager. The sponsor, we work with the top 20 or so sponsors out of probably over 100 in the industry. And, the nice thing is that you don't have to go pick a manager. It's already, assigned, and also there's economies of scale on this, so the management fees are very reasonable. Kind of the second, benefit would be access again to these institutional quality real estate properties. Most people, just can't afford to own a multi-million-dollar, apartment complex, or say an Amazon warehouse, or a hotel, or mineral rights. But through this partial ownership, you can actually get access to a lot of these very good quality investment opportunities in real estate. Third is really the limited personal liability loans. So the sponsor will create the loan, and there's no recourse to the investor. So there's no way that they can come after you if the DST was to default on the loans. And defaults have been rare, if ever. They just haven't happened. So, and the other nice thing is that the DST is the sole borrower, so they're the only ones that have to qualify. So particularly in this high rate environment where it's really challenging to qualify and the banks are not willing to lend, it's great because you're working with institutions that, instead of having to pay 8, 9, 10% interest, they can finance these things because they have such massive, strong balance sheets that they can get, lower rates.
So when you say institutional quality investors, you're talking about large private capital companies so that they can fund themselves.
Yeah. So the sponsors are the ones that are these massive, typically multi-billion-dollar companies. But when I'm talking specifically about, institutional quality, most of us don't have 20 to $30 million or more to just go out and acquire a property. This is a great way for you to access. So, here's an example of a property that, might cost $20 million to acquire, but you can own it for as little as $100,000. You just have a fractional ownership of it.
They're able to take a certain number of 1031 exchange investors by the Delaware Statutory Trust laws.
That's correct.
Accredited investors.
Yeah, so I forget the exact. Oh, it's 1,999. So one less than 2,000 people, and usually, these things sell out with smaller numbers of investors because they're even institutional investors like these because they're simpler.
And then you have diversification as well, right?
Yeah. So the great thing about these is, you're not limited to, say a region, Oregon, Washington, Idaho. You can pick up properties all over the nation, Arizona, Texas, Florida. And not only can you diversify geographically across the states, you can also diversify into what types of sectors you're in. So you might have some in, self-storage, you might have some in industrial, you might have some in hotels, you might have some in multifamily. We can tailor that based on the individual investor's personal preferences. For example, we work with a gal who was a pharmacist. And so she bought life science buildings because she knew that industry and knew that it was stable. And so put, 80% of her portfolio into that and then did some other things just to help diversify that.
Let's go ahead and start talking about the timeline. So I always really promote the idea that if you don't know where your money is going, then don't think about selling anything. You should have a really good idea. Why risk paying all those taxes if you don't have a good idea of the market you're getting into? So that's why we're learning more about all the different possibilities. There's DSTs, there's UPREITs, there's real property, there's investing into any kind of investment property at all. There's a lot of different options, but DSTs are special because one of the things it does is they're kind of always available if you're an accredited investor, right?
So a couple of things when you're in that 45-day window, so you sell the property, the most important thing is that we work with you ahead of time before you actually sell the property to make sure that when you sell it, that money ends up with a qualified intermediary.
Right.
If you missed that and the money came right to you, then we've got to talk a whole different investment strategy.
And you made a qualified intermediary. So that is the person that holds the money or the property during the process so that the IRS knows you never touched it.
That's correct. And they're there to make sure that you follow all the IRS rules in that exchange process.
Absolutely. So we've got day one. You finally close on the property.
Mm-hmm.
As soon as the appraisal and the loan contingencies are done, what I will do is start making offers on other properties. But you have three in a general identification process. You have up to 3 properties you can identify in a 45-day period. And then you have to close on one of those within 180 days,
That's
right?
Yep.
A DST is considered like-kind real estate.
It is like-kind real estate. And this is where you and I work together. The nice thing is, like, let's say you're identifying 3 properties and Harlan finds you sell a property for $1 million. And Harlan finds, 2 really great properties. One's for, 1.1 million. So you got to bring in a little bit of cash or finance that. That's fine. And then let's say the other one's for 900,000. And then what you want to do is identify a DST so that if the other 2 fall through, you know for sure that you can actually close on that DST. When we close, it's a very quick and efficient process. So we start working with investors prior to the time that they actually list the property. So when they've got it listed, we know, or when it sells, we actually know which DSTs they probably want to get into.
Right.
So they might want to identify one right off the bat. And then maybe Harlan's got a couple properties. Now, let's say the first one falls through for, 1.1 million, and the next one's available for 900,000. And you as the investor decide, man, I want to get that one, but what do I do with the extra $100,000? And that's where the DST comes in. It's called boot. And we can actually, take that boot, that basically extra proceeds, and we can invest every penny of it into a DST so that you make sure that you don't actually have to pay any taxes on that transition. Harlan and I can partner together to help defer and eliminate all that taxes. So for instance, Harlan and I can work together as we're identifying properties to make sure that you can defer all of those gains and swap that until you drop.
Yes.
So, if he's got a great replacement property, and again, you net $1 million in proceeds, he's got a great replacement for 900,000. And let's say the leftovers are $111,000.11. We can use every penny of that so that you don't have to pay any of the taxes.
Yeah, absolutely. And I think what we call that is 1031 exchange insurance. So you
That's
have
right.
that third placement can be a DST. Now, does that have to be a specific DST already identified? It has to be a very specific one. You can't just have a general DST.
No. Yeah,
Right.
you have to identify the specific DST. And the interesting thing is there might be, multiple properties in there. We, have some DSTs with as many as 20 to 25 properties in there. But you name one DST, that's, only one thing that you have to identify.
So you have to be careful that is going to be available for you.
That's correct. Yep. So you got to be careful on the DSTs because, sometimes these are really hot. They'll come out and they might sell out in 24 hours or, in 2-3 weeks. It's not unheard of. It happens quite frequently. So you want something that is going to be available 45 days from now. So you've got that insurance.
Yeah, and I want to go back to the concept that this is no management responsibilities. This is your you are done. It is a turnkey kind of investment, and they run about 5 to 10 years. And then you can either buy another DST or you can buy real property at that point again, too. It just cycles just as if you would have had a sale. Some of these have returns when they sell the DST.
Oh, yeah. So when the DST cashes out, let's say you put in $1 million, you're going to also then capture the gains, the capital gains on the appreciation of the value of that property. And, maybe you held it for, 5 years and, you get back, you put in 100,000, you've got that cash flow during that time frame, 4 or 5%. And then you get back the property and, that million's now maybe $1.3 million or $1.4 million. Then that money goes back to the qualified intermediary and you can exchange that for another DST, or maybe Harlan at that time has some better deals. And so you can get back into, physical properties that you want to own.
Yeah, and there's a lot of different ways to do like-kind. You've got everything from multifamily apartments, healthcare, self-storage, retail centers, industrial warehouses, student housing, which can be big, senior living, hospitality. So there's something for everybody.
And one that's not even on there is mineral rights. We actually, it is a like-kind property, and we have clients that own, we've exchange them into mineral rights. And so we've got information on that as well.
And again, you're only buying these from a qualified securities person. You have a securities license.
Correct.
Realtors do not sell these. I do not get a commission for referring on those if I do so. This is a solution, though, that can solve a lot of problems, but it has to be an accredited investor working through a wealth strategist.
That's correct.
Yeah, I just want to be clear with that with everybody.
And you want to be careful who you work with, because there's over 100 DST providers out there, and so you really only want to deal with the top, the highest quality, because some of them just aren't as financially strong as others. And so we do a lot of due diligence. We're comfortable putting our reputation on the line. So yeah, the really the key important thing here is be careful who you get your DSTs through.
Right.
You want to work with a reputable company that really does a lot of due diligence. There's over 100 DST providers out there, and some financial services firms only had, a couple of offerings, where we have, very robust offerings, but it's also very quality offerings. We really take about the top, 15 to 20% of the industry providers and work with them.
Yeah, and
Just to keep
the
a high
returns
quality
didn't sound
profile.
huge, but remember, we're saving capital gains taxes
Yep.
as well. There are some that have higher returns, some lower returns, but it's just you have to go step by step, and then you have risk and reward as well.
Yeah, there's other DSTs out there that, have some higher returns, maybe on the higher end of 5 or 6, but now you're also pushing into some risk areas that we're just not comfortable with.
Right, and let's look at the downside of DSTs. These things are not liquid.
That's
There
correct.
is a resale market, but it's not something you want to work with, correct?
That's right. Yeah. So that's partially why we only work with accredited investors. We want to, one of the first things we're going to ask is, what are your cash reserves? And what other investments do you have, so that, if something happened, you lost your marbles and ended up in memory care, you wouldn't have to tap into this, and that you've got other resources to take care of that. So, we're only going to allow a certain percentage, and the SEC, limits what our percentage allocation is to DSTs because they're not liquid.
Right, and you can't add money to the investment. It's a one-time shot.
Yeah, so you put in $100,000, and then you have a windfall and you have another 50 grand. Well, you can't add that to that same investment. You actually have to go probably find another one.
So you cannot renegotiate the loans on these
That is correct.
like you could on a building you purchased.
That's correct. Yeah, and there's some advantages to that. Partially is you're working with institutions with, billions of dollars in assets. And so they're able to get refi, real estate investors can't get, or they can finance, at lower rates, 4, 5, 6%, when everybody else is looking at, 8, 9, 10%.
Right.
So there's some real power, and advantages, and particularly in this high interest rate environment, to working with the DST providers.
Right. You cannot affect the property though. Like if I buy a property, I can go and I can improve it. I can
Nope.
have work done to it. I can do capital improvements. I can maintain it. But not only can't you do that, but you don't have to do it with these.
That's right. Yeah. And the other thing is you'll never get a call from the, tenants that, or have to deal with trash or toilets. You won't get the call in the middle of the night. Hey, the toilet's overflowed, or I need a hot water heater, or, maybe you own a grocery store and, somebody drove through the front and, crashed it. There's insurance to take care of that. And you don't have to cough up any extra cash, and you won't get a call.
Gotcha. How do they communicate with you pretty well about the investment once you're in it?
Each provider is slightly different. Some of them provide quarterly updates. Actually, I just had one group that provided an economic update and what they see coming, and we're allowed to pass that on to investors, and they're allowed to join webinars on those. So it's super informative.
Yes, because they'd love to own big properties like this, but they have no idea like how they would do such a thing. Accredited investors may have an idea, but now accredited investors can like go and meet with a security advisor and start to really look at the numbers here, see if it's something they might want to take their wealth and continue to defer it without managing it.
Yep. So, the picture you're seeing there is some examples of one of the groups that we work with, one of the DST providers. What they look for is recession resilient properties. What I mean by that is that during a recession, their cash flows are going to stay very stable. Even when COVID hit, they continued to have 100% occupancy and receive 100% of the leases that were, had been negotiated earlier. So nobody missed a payment.
Oh, good.
And, they'll put together typically 20 to 25 of these properties. So you'll have, CVS pharmacies, Walgreens pharmacies, Kroger grocery stores, they love Dollar General stores, auto parts stores, phoresis. Nobody misses dialysis in a recession. And when you look back historically in 2008 during the financial crisis, the net operating on these was very stable and growing when a lot of other sectors got hit.
Well, that's fantastic. So this is really good information. And if you want more information, you want to deepen your DST knowledge, just join the creative 1031exchange.com community. We'll send you our newsletter, and we can also send you specific information. If you tick the box, we'll send you specific information on DSTs. We would ask you to be an accredited investor, and if you're not one, then you can contact us and we'll help you become one. Very appreciative of your time today, talking about the benefits of Delaware Statutory Trust, Steve.
Yeah, thank you for inviting me. I love teaching people about this stuff, whether you do business with us or not. And we've got history of both. So we just want to make sure that, it's the right fit. If it's not, and that's why we love working with you, Harlan, because you also do the same thing. You educate people on their options. And it's great because then we can partner together to do the best, what's in the client's best interest.
What we try to do here at Creative 1031 Exchange is bring you the best information and the best qualified people to bring you that information. And then if you want more information, please contact us and we will get you in touch with our various experts. No obligation. Thank you very much for joining us. And thank you to Stephen. And we are here for you at Creative 1031 Exchange to help you swap till you drop. Please go ahead and fill out the form and we'd be happy to put you on our email list. Thanks so much. And please remember to like this video and subscribe to learn how to continue to build wealth through real estate.